Welcome to the Pro Ticker Deep Dive.
It's good to be here. Although, looking at the screens today, good might be a bit of a strong word.
I was just going to say it is. Well, it's Thursday, February 5th, 2026. And if you're listening to this and you've had the courage to look at a trading screen at all this week, you probably need a stiff drink.
Or maybe two, yeah. It's chaotic out there. That really is the only word for it.
Chaotic feels like a polite understatement. We are kicking off the month with a tech sell-off that feels, I don't know, visceral. And I want to get right to the heart of it because I think a lot of people are feeling this very specific kind of anxiety right now. For the past year, really all of 2025, we've had these little dips, right? You get a 2% drop here, maybe a 3% drop there. And the muscle memory has been so deeply ingrained in everyone by the dip.
Right, it became a Pavlovian response almost. You see red, you buy calls, you make money. It worked every single time.
Until it didn't.
Until it didn't.
Yeah.
And that's where we are now.
Exactly. The vibe this week, it just feels different. It feels heavy. And, you know, on the surface, if you just glance at the Dow or maybe some of the broader indices, things might look somewhat stable. It's almost this illusion of safety.
That's a perfect way to put it.
An illusion. But if you pop the hood, if you look at the internal market fragility, there's some serious, serious damage being done under the surface.
That's the key phrase right there, internal market fragility. You can, paint the exterior of the house all you want, but if the foundation is cracking, you've got a fundamental problem. And we are seeing cracks everywhere.
So this brings us to the central conflict we need to try and solve today. This is the question that's dominating every trading desk, every group chat, every financial news show. Is this it?
The big one.
Is this the bursting of the AI bubble? Is this the dot-com crash 2.0 we've all been whispering about? Or is this just a healthy, albeit incredibly painful, sector rotation, a correction we had to have?
That is the multi-trillion-dollar question, isn't it? And I think to even begin to answer it, we have to understand the specific label that analysts and, frankly, the market itself is slapping on 2026.
Which is?
They're calling this the year of proof.
The year of proof. Wow, that sounds ominous.
It's meant to be. I mean, think about it. For the last 3 years, we've been trading on promises. Promises of generative AI, promises of these massive productivity revolutions, promises that chatbots were going to replace half the workforce.
It was all narrative, pure story.
100% narrative. And in 2026, the market has just, abruptly stopped caring about the story. It's demanding revenue. It wants to see the receipts. Show me the money.
Right.
And right now, specifically this week, the market is absolutely punishing anyone who cannot show them those receipts immediately.
So the patience has just evaporated. The whole trust me, bro era of AI investing is officially over.
Completely over. The grace period has expired. The bill has come due.
Okay. So to help everyone navigate this mess, we have a very stacked roadmap today. We're not just going to sit here and rant about red arrows on a screen. We're going to break down the tale of two titans. That's the SPY versus the QQQQ, and why they are practically living in different universes right now.
A crucial distinction.
Then we're going to do a forensic anatomy of the crash. We're going to look at the technicals, the charts, and the specific quant funds that are actually making this move worse.
And we absolutely have to get into the physical reality of it all. The physics of the market, I call it. We're going to talk about power grids, CapEx spending, and why the laws of thermodynamics are actually hammering hardware stocks at this very moment.
That part is just fascinating to me. But look, we won't leave you hanging with just the doom and gloom. We are going to talk strategy. Where is the smart money actually rotating to? And I'll give you a hint. It is not cash, and it is not just buying the dip in NVIDIA again.
Definitely not.
So let's start with the vehicles, the two titans. If you're trading this market, chances are you are using the SPY or the Qs.
The two behemoths.
Yeah.
The most popular ETFs on the entire planet. They are the market for most people.
But they are behaving so differently. I want to define them really clearly, not just as, market up or market down butters, but structurally. Let's start with the big one, the SPY. What is under the hood of that SUV?
So the SPY is the SPDR S&P 500 EPF Trust. And I love your analogy of the SUV. It's a perfect. Think of this as the cruise control of the market. Its job is to track the S&P 500 index.
The benchmark.
The benchmark. It's designed to give you broad exposure to the entire U.S. economic machine. So it holds about 500 of the largest U.S. companies. Now, because tech has become so massive over the last decade, the SPY does have significant tech exposure. We're talking roughly 33% to 35% as of this morning.
Which, if you look back historically, is still an incredibly heavy tech waiting for what's supposed to be a broad index.
Oh, it's huge compared to 20 or 30 years ago.
Yeah.
But, and this is the critical distinction right now, it's diversified. It includes financials. Big banks like J.P. Morgan, insurance companies. It includes industrials, healthcare, consumer staples, the boring stuff.
Explain that concept of ballast. Why do I, as an investor, care if my ETF has some boring bank in it when I'm just trying to catch the next big tech rally?
Because when the tide goes out, you find out who's swimming naked. The ballast is what keeps the ship steady in a storm. Think about it. When interest rates are high, which they are, big banks tend to print money. Their net interest margins explode. So when tech is getting hammered because high rates are crushing their valuations,
The financials in the SPY are actually doing well.
they act as a shock absorber. It's that simple. It keeps the vehicle from swerving off the road. Plus, you have to remember, the SPY is arguably the most liquid financial instrument on Earth. We are talking about massive daily volume,
What's the number on that?
around $31 billion in average daily volume. The spreads are ridiculously tight, literally 0.29 basis points.
So for anyone listening, that just means the difference between the buy price and the sell price is microscopic. It's pennies.
Exactly. And that's why it's the go-to for big institutions. It's where they hedge. They know they can get in and out with billions of dollars without dramatically moving the price against them. It's the reliable, heavy-duty suspension system of the market.
Okay, so SPY is the reliable SUV. It can handle a pothole because it has those banks and healthcare stocks to absorb the shock. Now let's talk about the other one, the QQQ, the sports car.
The QQQ, or the Qs as most traders call it, this tracks the NASDAQ 100. And if the SPY is an SUV, this is your high-octane twin-turbo Ferrari. It holds about 100 companies, but here's the kicker, the detail that people often forget.
No financials.
It explicitly excludes financial companies. No banks, no insurance firms, nothing.
That feels like a massive, massive detail given the current interest rate environment we're in.
It is the most critical detail. Without financials, you completely lose that cyclical protection, that ballast we just talked about. The QQQ is just massive tech exposure. Over 50% is pure play technology. But then you have to add in what we call tech adjacent sectors.
Like what?
Communication services, that's your Meta and Google, and consumer discretionary, that's where Amazon and Tesla live.
Yeah.
When you add it all up, the concentration is just staggering. The top 5 holdings alone
Just 5 companies.
make up somewhere between 40% and 45% of the entire fund.
Wow, that is just wild concentration risk. I mean, basically, if 5 CEOs wake up on the wrong side of the bed, almost half your portfolio takes a massive hit.
Precisely. And that's why it has a higher beta, usually somewhere around 1.2 to 1.3.
Can you define beta for us quickly for the folks who aren't, glued to a Bloomberg terminal all day?
Sure. Beta is just a measure of a stock's or a fund's volatility relative to the broader market, which is usually the S&P 500. A beta of 1.0 means you move exactly in line with the market.
So S&P up 1%, you're up 1%.
Exactly. But a beta of 1.3, like the QQQ, means if the S&P goes up 1%, you're probably going up 1.3%. But, and this is the important part, it works both ways. If the market drops 1%, you're dropping 1.3%. It amplifies everything, the good and the bad.
And that amplification brings us directly to the divergence we are seeing this week, in early February 2026.
Right, because the QQQ is acting as the absolute epicenter of this sell-off. The Ferrari is spinning out of control.
It's spinning out because this is a valuation squeeze, as you called it. The high beta growth engine is stalling out completely.
Investors are fleeing the hardware trade, the chip stocks, the semiconductor companies, which are all heavily weighted in the QQQ. Meanwhile, the SPY, the SUV, is holding up slightly better. I mean, it's still down. Don't get me wrong. It's not a pretty picture.
It's not immune.
Not at all. But those boring old banks and healthcare companies are acting as a cushion. The SUV is hitting the bumps. But the Ferrari has lost all traction and is careening towards the guardrail.
And when a Ferrari spins out at high speed, it leaves some serious skid marks on the pavement, which I think transitions us perfectly to the technical damage. I love this phrase that technical analysts use, retracing to the scene of the crime. Talk to me about what just happened on the charts.
This part is just, it's fascinating if you're a market technician or even if you just track market psychology. So for the last 5 years, basically dating all the way back to the COVID lows of March 2020, the S&P 500 has been riding this beautiful, clean, parallel trend line upward.
And it was the floor, the ultimate line in the sand that told everyone the bull market was still intact. Every time we touched it, we bounced.
Like clockwork. It was the most reliable support level in the world. But this time,
Yeah.
we didn't just break it, we completely violated it. In late January, the index sliced right through that line. But here's the scene of the crime part. This is the key. Often, when a major support line breaks, the market doesn't just keep going down. It tries to rally back up to it. It tests that line from the underside.
It's like it's checking to see if it can get back into the club, but the bouncer says, nope, you're not on the list anymore.
That is the perfect analogy. The old floor becomes the new ceiling. And that's exactly what happened last week. We rallied back up, we kissed that old trend line, and we were immediately violently rejected. We failed the test.
Technical analysts call that a retest failure.
A classic retest failure. And historically, when you break a major multi-year trend line and then you fail the retest, the probability of further significant downside increases to something like 70%.
70%. Wow, that is a very sobering statistic. So we are not just looking at a bad week, we're potentially looking at a major structural shift in the market's behavior.
It suggests that the path of least resistance has now shifted from up to down. And if you think that chart looks bad, you should see the QQQ. It looks even worse.
How so?
It tested its primary trend line 5 separate times over the past 2 years. 5 times it bounced. But this time, in early February, it just snapped. There was no fight. And now all eyes are on that big psychological 20,000 level on the NASDAQ.
I want to dig a layer deeper into why the drop accelerates so quickly. It's not just fear. There's a mechanical element. I keep hearing these sophisticated traders throwing around terms like gamma, specifically negative gamma and put walls. It sounds like something out of a sci-fi movie.
It does, but it's very real.
Can we break this down? Like, explain it like I'm 5. What is physically happening in the options market around, say, the $520 level on the QQQ that makes the drop so violent?
Absolutely.
Yeah.
So let's start with market makers. These are the huge institutions, the JP Morgans, the Goldman Sachs of the world, that facilitate trading. If you want to buy a stock, they sell it to you. If you want to sell, they buy it from you.
They're the house, the casino.
They're the house.
Yeah.
And their primary goal is not to bet on the direction of the market. Their goal is to stay neutral and just make a tiny commission, the spread, on every trade. They want to balance their books so they don't get wiped out.
Okay, that makes sense.
Now, imagine a massive number of investors, retail, hedge funds, everyone bought put options, with a strike price of $520 on the QQQ. A put option is basically a bet that the price will go down below that level.
Right. It's insurance or a bearish bet.
And when all those investors buy those puts, who do you think is on the other side of that trade selling them?
The market makers.
Exactly. So the market maker is now on the hook. If the QQQ crashes below $520, they have to pay out massive amounts of money to all those put holders. So how do they protect themselves from that risk?
They have to hedge.
They have to hedge. As the market starts dropping towards $520, the probability of them having to pay out on those puts goes way up. To hedge that risk, they have to start short selling the actual QQQ ETF or the futures. They need to make money on the way down to offset the losses they're about to take on the options they sold.
So wait, as the price gets closer to the danger zone, the very people who are supposed to provide stability are forced to sell, pushing the price down even faster.
Yes, and that's the feedback loop. That is the gamma trap. When the price actually crashes through that $520 put wall, the market makers' risk models start screaming. They flash red. Their models tell them they are now dangerously underhedged.
So they have to sell more.
They have to sell a lot more, instantly. And that massive forced selling drives the price down further, which in turn forces them to sell even more to catch up.
It's a mechanism. It's not that they suddenly hate tech stocks. It's that their algorithm says sell now or you blow up the firm.
Precisely. It creates what the pros call negative net gamma exposure. It acts like a powerful magnet, pulling the market lower and lower, specifically down toward the next big pile of puts, maybe at $515 or $510. That's why these sell-offs feel so synchronized and violent. It's not just humans panic selling, it's algorithms executing mandatory risk management protocols.
That explains the speed. It feels like the elevator cable just snapped. Speaking of things happening under the surface that you can't see, you shared a really interesting chart in our prep notes about OBV on balance volume and how it flashed a huge warning signal way back in November of 2025.
Yeah, this is what I call the smart money footprint. OBV is a technical indicator, but it's a simple one. It just tracks volume. It adds volume on up days and subtracts volume on down days. Think of it as a lie detector for the price action.
A lie detector. I like that. How does it work? What did it show?
Well, if the price of an asset is going up, but the volume, the actual amount of money and conviction backing that move is going down, that's a negative divergence. It's a huge red flag.
It means the rally is hollow. It's built on air, not on real buying.
We got it. So back in November 2025, the QQQ was still grinding higher. It was hitting new all-time highs every other day. It looked fantastic on the news. But if you looked at the OBV indicator, its trend line had already broken and was pointing down.
So the price was going up, but the big money, the institutional money, was quietly leaving the party.
Exactly. It was a classic sign of distribution. The institutions were quietly selling their massive positions to the retail investors who were still chasing the hype, buying the top. The smart money was taking profits while the headlines were still euphoric.
That is the classic bag holder scenario.
It is. The institutions distribute, and now, in February 2026, we are entering the markdown phase, where the price has to fall to find where the real buyers are again. It's the moment everyone realizes the smart money has already left the building.
Oof. I want to touch on one more mechanical factor before we get to the big bubble debate. The quant feedback loop. You mentioned this term degrossing. That sounds unpleasant. What does that mean for the market?
It is deeply unpleasant for anyone who is long the market. So you have these massive quant hedge funds. They use incredibly complex risk models, often based on something called value at risk, or VAR, and these models are heavily, heavily dependent on one thing: volatility.
The VIX, the fear index.
The VIX. So when volatility is low, like it was for almost all of 2025, the models tell the fund managers, everything is safe, it's calm, you can take on more risk, leverage up, buy more stocks.
So calm markets actually breed more risk and more leverage.
They absolutely do. But when volatility spikes like it has this week, with the VIX shooting up from 12 to 25, their models start screaming, danger! Danger! The math dictates that their current market exposure is now far too dangerous relative to their capital.
And the model doesn't ask for permission. It's not a suggestion. It just says sell.
It's a command. It's called systematic degrossing or deleveraging. They have to reduce their gross exposure to the market. That means selling their winning stocks, their long positions, and covering their shorts. They have to shrink their footprint to get their risk metrics back in line.
And again, it's mechanical, not emotional. But the problem is, because so many of these massive funds use similar volatility targeting models.
They all get the same signal to sell at the exact same moment. They all rush for the exit door at once.
And remember that liquidity difference we talked about earlier. The SPY has deep liquidity, but you noted that the QQQ spreads have been widening out.
Right. The QQQ spreads widen from under a basis point to 1.86 basis points.
Right.
Now, that doesn't sound like much to you or me buying a few shares, but for an institutional algorithm that is trying to offload billions of dollars of stock, it makes the exit door feel very, very narrow.
It creates a traffic jam.
A huge traffic jam.
Yeah.
And that liquidity crunch just amplifies the panic. You try to sell, the price gaps down instantly, and your model screams at you to sell even more, even faster. It's a vicious cycle.
So we've got technical breakdowns. We have mechanical selling from the options market via gamma, and we have quant funds deleveraging all at once. That is a truly nasty cocktail. And it leads us right to the biggest debate happening at every dinner table and on every trading desk right now. Is this the dot-com bubble 2.0?
It really is the elephant in the room, isn't it?
I mean, let's just look at the evidence for a second. The similarities are frankly eerie. You have these absolutely parabolic moves in tech stocks. You have massive euphoric retail enthusiasm. And I was reading that the S&P 500's PE ratio is over 40 right now.
Which is getting dangerously close to the dot-com peak of 44.2. It's in the same zip code.
And what about the Buffett indicator? Market cap to GDP. That's the one he calls the best single measure of where valuations stand.
That one's even scarier. It's at an all-time high of 226%. For context, in 2001, at the absolute height of the dot-com madness, it was only 132%. So by that specific metric, we are statistically more expensive and more speculative than the biggest stock market bubble in modern history.
Yikes. Okay, so is that it? Case closed. It's a bubble, and we're all doomed to repeat history.
Well, hold on. This is where it gets really, really interesting and why you have that central conflict we talked about. There is a massive, critical, fundamental difference between the year 2000 and the year 2026.
And that difference is profitability.
Profitability, cash flow. In 2000, you had companies like Pets.com. They had a cool sock puppet mascot for their Super Bowl ad, but they had no revenue, let alone profits. They were burning hundreds of millions of dollars of venture capital to acquire customers who were worth nothing.
It was all a land grab for eyeballs.
It was vaporware. Today, you look at the Magnificent Seven, Microsoft, NVIDIA, Google, Amazon. These are absolute cash flow machines. They are, without exaggeration, the most profitable companies in the entire history of capitalism.
So the quality of the companies at the top is fundamentally different. We aren't buying dreams and sock puppets. We are buying virtual monopolies that print money hand over fist.
Completely different animal. And here's a very nuanced stat that the bulls, the people who are buying this dip, absolutely love. While the S&P 500 PE ratio is high, the NASDAQ 100 PE ratio is actually significantly lower than it was in 2000.
Wait, that feels counterintuitive. How is that possible? You're saying the tech index is cheaper relative to its earnings than the broader market index.
In a way, yes. Back at the dot-com peak, the NASDAQ 100 was trading at a PE of around 60x. Some estimates are even higher. Today, even after this massive run-up, it's sitting somewhere between 26x and 30x.
So it's half as expensive on a PE basis.
Right. And what that suggests is that while the stock prices are incredibly high, the earnings, the E in the PE ratio, have grown so enormously that they've largely kept pace. So the expert insight here is that these big tech stocks are arguably cheaper today relative to their actual earnings power than they were during the internet bubble.
Okay, that is a very compelling bull case. This time it's different because these companies are real, but I know you, and I know there's a big but coming. What's the bear case? What is the problem with this year of proof?
The but is the CapEx problem, the capital expenditure. This is the new cloud hanging over the market. We're looking at a situation where just 4 companies, Microsoft, Meta, Amazon, and Alphabet, are projected to spend over $500 billion in 2026 alone.
$500 billion.
Yeah.
On what exactly?
Data centers, custom chips, the entire infrastructure to power this AI revolution. It is the biggest private infrastructure build-out the world has ever seen. But investors are starting to get what we're calling P&L accountability gap anxiety.
Accountability gap, meaning you are spending all this money now, but where is the profit from that spending now?
Exactly. Imagine you spend $1 billion to build a massive new factory. The cost of that factory, the depreciation, hits your balance sheet and your profit and loss statement today. But you haven't sold a single widget from that factory yet. The revenue from AI, the year of proof, is supposed to materialize, but it's lagging the spending.
And we're seeing the effects of that in their margins.
We are. Look at Microsoft's latest earnings. Their cloud margins, which everyone thought were bulletproof, actually dropped to 68%. Why? Because of the massive depreciation costs of all those new GPU clusters they're building.
And for years, investors viewed cloud as this infinite margin software business. They thought it was free money.
Right. And now, suddenly, it's starting to look capital intensive. It's starting to look like a utility. It looks more like an electric company than a software company. And that scares people. And on top of that, there's another major threat to the hardware stocks specifically: vertical integration.
This is the idea that the biggest tech companies are starting to build their own chips, right? To cut out the middleman.
Yes. If you're Amazon and you're spending tens of billions of dollars on NVIDIA chips, you don't want to pay NVIDIA their 70% gross margin forever. So what do? You build your own. Amazon has its Trainium chips. Google has its TPU V7, codenamed Ironwood. They're all designing their own custom silicon to save money.
So if you are NVIDIA, your biggest customers, the very hyperscalers who are giving you that $500 billion in orders, are simultaneously becoming your biggest competitors.
Exactly. And that threatens NVIDIA's insane pricing power and margins in the long term. And the market is trying to price that risk in now. That's a big reason why the chip stocks are getting hit so much harder than the software stocks in this sell-off.
So we have this incredible tension between massive profits today versus massive spending for uncertain profits tomorrow. And all of this is happening against a macro backdrop that isn't exactly friendly, to put it mildly. Let's talk about higher for longer. We've been hearing this phrase for years now, but what does it actually mean for investors in February 2026?
This is the wet blanket on the whole party. For a while, the market deluded itself into thinking that interest rates would eventually go back down to zero. That is just not happening. The expectations for 2026 have shifted dramatically. The consensus now is that the neutral rate,
The Goldilocks rate.
the interest rate where the economy is neither speeding up nor slowing down, is settling in a much higher range, probably around 3.50% to 3.75%.
And the 10-year Treasury yield, the benchmark for everything.
The forecast is for it to average around 4.55% for the year.
I want to pause here because this is a concept that I think still confuses a lot of people. Why does a 4.55% yield on a boring old government bond matter so much for a high-flying tech stock investor?
It matters because of financial gravity. Think of the risk-free interest rate as the force of gravity in finance. Most of the value of a high-growth company, like a tech stock, isn't from the money it's making today. It's based on the profits everyone expects it to make 5 or 10 years from now.
The future earnings.
Right. And when you have a high risk-free rate, like 4.55%, you have to discount those future earnings back to today's dollars at a much higher rate. It's the time value of money. $1 in 2036 is worth a lot less today if I can get a guaranteed 4.5% return in a safe bond right now.
So it mathematically forces the valuation down.
It mathematically compresses the PE ratio you can justify paying for that future growth. High rates act like gravity on high-flying tech stocks. The higher the rate, the harder it is for that stock to stay in the stratosphere. It has to come back down to earth.
Now we also have this new fiscal policy, the One Big Beautiful Bill Act, or OBBA. Aside from having a truly ridiculous name, what is that doing to the whole mix?
Well, it's a massive fiscal stimulus package. On paper, it looks good for the economy. It's supporting GDP growth, keeping it chugging along at around 2.25%. But all that government spending adds to inflation risks.
Which, in turn, prevents the Federal Reserve from being able to cut interest rates to help the market.
Correct. It puts them in a box. And it creates this K-shaped expansion. Companies that have mountains of cash, like the Magnificent Seven, they actually thrive. They earn interest on their massive cash piles. Apple is making billions just from the high rates.
But what about everyone else?
Companies that need to borrow debt to grow. Small caps, startups. They get absolutely crushed because the cost of debt is so high. So the rich get richer and the indebted get crushed. It's a massive bifurcation of the economy.
A tale of two economies. But you mentioned there's an even bigger constraint than money right now, and this is where this deep dive really gets interesting. There is a physical constraint.
The hard wall. This is the part that I think most people on Wall Street are still ignoring. You cannot code your way out of a power shortage.
You're talking about the power grid.
The U.S. power grid is the Achilles heel of the entire AI revolution. The latest projections show that AI data centers will consume 945 terawatt-hours of electricity by the year 2030. To meet that demand, the U.S. grid needs to grow its total capacity by 20% in just 5 years.
Is that even remotely possible?
From a regulatory standpoint, logistically, probably not. It takes years, sometimes a decade, to permit and build a single new high-voltage transmission line. We're talking about physical copper, steel, and concrete. So this physical bottleneck is a hard brake on the growth of the QQQ. If you can't get enough electricity to plug in the GPUs, you can't sell the AI services, period.
That is just a fascinating angle. We're so used to thinking of the digital world as being infinite, just spin up another server in the cloud. But you're saying we're actually running out of the juice to run the servers.
We are hitting the hard limits of physics in 20th century infrastructure. And the market is only just beginning to realize that the infinite growth curve of AI might be capped by the very finite capacity of our utility companies.
So, okay, we have painted a pretty scary picture. We have a technical breakdown, we have mechanical selling loops, we have macro headwinds, and we have actual physical limits. If I am a listener, I am probably gripping my steering wheel pretty tight right now.
That's understandable.
But we promised actionable strategies. The smart money isn't just selling everything and sitting in cash, are they?
No, they never just sit in cash. Cash is a guaranteed loss to inflation. They rotate. It is not an exit from the market. It is a rotation within the market. Capital is fleeing the hardware trade, the chips, the semis, because the valuations are nosebleed high and the risks are growing.
So where are they going? If I want to follow the smart money right now, where do I look?
From hardware to services. Destination number one is the communication services sector. The ticker for that ETF is XLC.
XLC. Okay, why that specific sector?
Well, firms like RBC Capital have recently upgraded this sector to overweight. And you have to think about the companies in it. Meta, Alphabet, Google, Netflix. These are what we call service tech.
And how is that different from hardware tech like NVIDIA?
They're the ones who are actually monetizing the AI. Meta is using artificial intelligence to make its ad algorithms more powerful and efficient right now. They aren't just spending $50 billion on chips for some future payoff. They're showing the market how that spending turns directly into higher ad revenue today. The thesis is that this is growth at a discount. They are trading at much lower multiples than the chip makers, but they still have that incredible growth potential.
Okay, so XLC is the offensive play. It's still in the tech world, but it's applied tech, not building block tech. What's the defensive play? Where do you go to hide?
Healthcare. The ticker for the sector ETF is XLV.
Why healthcare? It seems so boring.
Boring is beautiful in a bear market. Look, regardless of whether the AI bubble bursts or interest rates stay high for another 5 years, people get sick, they age, and they need medicine. It is the ultimate defensive ballast. But it also offers that breakthrough science upside. It's not just boring, steady Eddie pharma companies. You've got biotech and medical devices in there too, but fundamentally it's about earnings stability. When the economy gets wobbly, you buy what people need, not what they want.
So it's a barbell strategy, service tech for growth, healthcare for safety. What about the people who still want to be in the S&P 500, who still believe in the U.S. economy, but are just terrified of that concentration risk we talked about? The ones who don't want their entire portfolio to implode just because Apple or Nvidia has a bad quarter.
The answer there is simple, and it's elegant. Equal weight. The main ticker for that is RSP.
Explain how RSP is different from the SPY. They both track the S&P 500, right?
They do, but they're constructed very differently. In a normal cap-weighted S&P 500 index like the SPY, Apple and Microsoft have a huge weight, maybe 7% each, because they are gigantic companies.
Yeah.
In RSP, every single company in the S&P 500 gets the same weight.
So the 500th largest company in the index has the exact same influence on the fund's performance as Microsoft does.
Exactly. Each company is about 0.2% of the fund. So if Nvidia crashes 20% in a single day, it barely makes a dent in your overall portfolio because it's such a small piece of the pie. It dramatically reduces that idiosyncratic risk of the top 7 names blowing everything up.
Has that been working during this sell-off?
It has. And interestingly, the Tech Equal Weight ETF, ticker RSPT, has held up much, much better during this February sell-off than the cap-weighted QQQ. It proves that the pain is really concentrated in those mega-cap generals. The average tech stock is actually doing okay. It's the giants that are stumbling under their own weight.
That is a fantastic, actionable tip for people. Look at the equal weights to stay in the game without taking on all that single stock volatility. Before we wrap up the strategy section, I have to ask you about leverage. I saw a scary number floating around. $1.2 trillion in margin debt.
It's a record high. And this is the danger zone. This is where people get wiped out. When volatility spikes like this, brokers issue margin calls. If you are trading on margin or if you're using those crazy leveraged ETFs, the 3X bull funds, you are walking directly into a buzzsaw right now.
Because of the volatility drag, the daily rebalancing?
It's the volatility decay and the simple risk of ruin. The private credit markets are also very vulnerable here. The advice is simple: de-lever. This is not the environment to be borrowing money to buy stocks. Cash creates optionality. Debt creates obligation. In a chaotic market, you want options, not obligations.
Loud and clear. Okay, let's try to synthesize all of this. We were witnessing a shift, a new era, as you called it. We're shifting from AI 1.0 to AI 2.0.
All right. AI 1.0 was the gold rush. It was buy everything that plugs into a wall. Buy the chips, buy the infrastructure, buy the shovel makers. That trade is now very crowded, it's very expensive, and it's starting to unwind. AI 2.0 is the year of proof. It's asking, who's actually making money with this stuff? The market is punishing speculative demand and rewarding durable, proven growth.
And the smart money is looking beneath the surface of the major indices. They aren't just blindly buying the dip in the QQQ anymore. They're being surgical.
They're being surgical, and you should be too. My advice is don't fear the volatility, but understand the mechanics behind it. Know that the quants are selling because they have to, because their models tell them to, not necessarily because the world is ending. But you have to respect the technical damage. That scene of the crime trendline break on the S&P 500 is very real. Until we can get back above that level, caution is the watchword.
As we close out, I want to leave our listeners with that provocative thought you mentioned earlier, the one about the size of the market versus the size of the economy. This one really stuck with me after we talked.
Yes. So just consider this for a moment. The market cap to GDP ratio, the Buffett indicator, is at 226%. What that means, in simple terms, is that the U.S. stock market is valued at more than double the size of the actual U.S. economy that it's supposed to represent.
Which is historically unprecedented.
By a wide margin.
Yeah.
The bet that everyone in the market is implicitly making is that AI is such a powerful revolution that it will cause the economy, the actual GDP, to explode upwards and catch up to the stock market's valuation.
But what if it doesn't? What if AI just makes a few big companies richer but doesn't grow the whole pie?
Then you have a problem. If the economy grows at a normal historical pace, then the stock market has to crash down to meet the economy. That massive gap between 226% and the historical norm of roughly 100%, that is the risk premium you are holding in your portfolio right now. The answer to whether AI can grow the physical economy fast enough will, I believe, determine your portfolio's fate in 2026.
Heavy stuff. But that is exactly why we do this deep dive, to get past the headlines and the noise and look at the actual gears turning the machine.
Always a pleasure to break it down.
That's it for this week's Pro Ticker Deep Dive. Stay safe out there, watch your leverage, and we will see you on the next one.
Good eye.